Good afternoon, ladies and gentlemen, and welcome to Finom Group's inaugural YouTube video with me, Seth Golden, your host, founder of Finom Group back in 2017, actually, the day after Christmas, December 26th, we went live, and we have never looked back. Finom Group, we try to cover all the bases for investors and traders, market participants of all shapes, sizes, industry background, levels of expertise, so on and so forth. And what we try to do is basically give everybody the tools to be a successful, well, you could be an analyst, you could be a Fed watcher, you could be a trader, someone who's, just swing trading, day trading. We prefer long-term investors, simply from the standpoint of that is your safest and most disciplined art form when it comes to investing. So here's our Finom Group homepage. Every now and then we have a daily article that we send out free to the public. A lot of good insights and information in there. But our coup d'etat, if you will, is our research reports. We put one out every Sunday morning, usually by 9 o'clock a.m. on the East Coast. And it's very in-depth, very detailed, gives you a snapshot of what happened in the trading week that was, everything from your technicals, what sectors were moving, what sectors weren't moving, and why they were moving, your major averages in movement, all your breadth indicators that you need, want, desire, so far as what's meaningful. There's hundreds of breadth indicators. So if we were to look at every breadth indicator and analyze each one, we'd have a 200-page research report. Having said that, our research reports tend to be anywhere from 30 to 45 pages. And again, they're very detailed. As you can see, this was a look at the S&P 500 from just the other week. Nice breakout here of this descending trend line to all-time highs. How do we get those all-time highs? Well, we had the Pfizer vaccine announcement last week, Monday. Coming into this week, what do we get? Another vaccine for COVID, vaccine announcement to fight COVID from Moderna. Could we see this coming? Absolutely. In fact, in this research report, towards the end of the report, we talked about, if we are going to stick with the 2009 analog, which, by the way, this market has been modeling very, very well, tracking very well, it would take some kind of a vaccine announcement this week. Why? Because this week we're supposed to travel 2% higher in order to stay on course or stay on track with the 2009 market S&P 500 analog. But just kind of combing through our weekly research report here, as you can see, a lot of charts. 2 weeks ago, we talked about Caterpillar. We like Caterpillar. We think it's a buy on the dip. Caterpillar dipped last week down to 151, finished the week around 171. Like it long term. This is one that you can stick in your portfolio, and 2021 should be a much better looking stock, appreciation and whatnot. Boeing is one that we really like, and the chart speaks for itself. This is about risk reward. Not a lot of charts will line up this favorable to or this skewed to the reward side. And what we basically look at is a very simple chart. There's no lines or anything on this, other than tracking the share price action over the last 2-year period. You get this watershed, waterfall type, movement in the stock, but then it doesn't retest, and it has a really difficult time going lower over several months. Basically tells you there's a good floor there underneath the stock. And this is Boeing, folks. A lot of this was predicated upon of course, COVID-19 and the March lockdowns and the travel and leisure industry and the global pandemic. But then you had all of the negative headlines. Sentiment really took a dive. No pun intended for the 737 MAX. But all of that is in the rearview mirror, and yet the stock still could not hold over the last several months below $150 a share. Folks, this is the risk. This is the reward. I'm of the opinion that going into 2021, we should be able to see as the fundamentals start to shift in favor of, long-term earnings and sales, you're going to see the sentiment shift as well. So a few weeks ago, we included this in our research report. We just wanted to re-up it this week so that our members, can really take a second look. I manage also the Golden Capital portfolio, and we added Boeing shares into the Golden Capital portfolio a few weeks ago at $168 a share. We can see today where it closed. Boeing has been on a pretty good track here the last week and a half. It closed at 210. Our objective is at least 250. As the tide changes, as the sentiment shifts, fundamentals start to improve, the orders are going to come back for Boeing. Boeing is a long-term hold. So even though it's moved up really rapidly, I'm more inclined to increase my exposure to Boeing on dips than I am to sell here or 220 or 230. I want a bigger piece of Boeing going forward. Anyways, just kind of a look here at Finom Group's research reports. A lot of good charts, a lot of good analysis. A lot of good analysis in here. Always be in the market. Always be in the market, right? Well, we see so many people out there, they try to tie tops. They look for breadth divergences. They're always looking for a problem in the market whereby they can, try and realize a top and buy those shares that they sold at the top at lower prices. If we're just speaking about the S&P 500, selling the spiders at the top and trying to buy them back lower, rinse, wash, and repeat, ride the wave back up to new highs in the future. More often than not, what you're really doing is just inviting volatility into your portfolio. If we go back to 1954, S&P 500 buy and hold 11% annually, KR. Dollar cost averaging 9.9%. Equity mutual fund flows 6%. T-bills 4%. Just stay in the market, folks. If you want more exposure, if you want to increase your your annual profits, you got to get into sector picks, sector ETFs, and some stock picking. But by and large, we live in this world of index and sector ETF investing, and it works. It works. It's not sexy. You're not going to get a 400, a Tesla type move, but it works. And you kind of eliminate a lot of the volatility in your portfolio as well. If you're not an investor that has a lot of time to dedicate, to doing due diligence and reading different articles and reading different reports on this stock or the general market, deciphering sentiment here and there. If you're not that person who has that type of time, index investing will get it done. You're just not going to have, these double-digit years that you might have if you are a good stock picker. But stay in the market. Don't try to time the tops. It's always good to buy dips. It's an easier practice than it is to try and time a top, because you're not just trying to time a top. You're trying to time when you're getting back in. It's a double-edged sword. Most of the time, when you do see the stocks falling in price, when you do see the major averages falling in price, even after you've gotten out of the type, all of a sudden you're thinking, no, it's got farther to go down. And you're sitting on your hands and you're waiting because you think it'll go down farther. Or it's just the way in which the market is declining that invites a little bit of fear. And all of a sudden, you're less inclined to buy those shares that you were originally hoping to buy on the dip. It's easier just to keep your market exposure, cash on the sidelines, put it to work on those dips. Market will go up over time. Market goes from the left-hand corner, the lower left-hand corner, to the upper right-hand corner over time. Your main objective, be in the market. Give yourself time in the market. Let's see. So here's a perfect, and don't short the market. You don't want to be those guys either. It takes a very strong expertise to short the market. Speaking of the S&P 500, I mean, if you just look at this chart right here, right? This goes back to, the February-March period. Looks pretty simple, right? Well, if I had shorted the market here, I would have done very well. Would you have? Did you have the courage here when you saw this significant spike back up? This bounce, if you will. But in the moment, did you know it was a bounce? Did you know that bounce would not stop and we'd keep going up? Or that it would, and we go to this level, and you get another reflex spike or dead cat bounce, as they say. Did you have the courage to hold on to that short here? Shorting is a very difficult process, and most people would have gotten out here or here. They would have not ridden the market all the way down. Best thing that you could have done, the easiest thing that you could have done during this time period was, look at your brokerage account and say, what if I added some cash to my brokerage account and afforded myself the opportunity to buy such a dip? Well, it would have been a very good decision, an easy decision, and a profitable decision. Yeah, but I didn't know that. Well, we live in a world where the politics don't permit for a prolonged market contraction or a recession. The Federal Reserve moves much more quickly than it did even in 2008. Fiscal, policy comes to the rescue that much quicker than it did in 2008 also. There's just no stomach in politics for recessions anymore. There's no stomach for, 20% bear markets even anymore. And when they happen, as they did this year, they happen so fast, 17 days. It took 17 days for us to get into a bear market this year. And this was a month. This was basically a month. February 22nd, we hit the bottom on March 23rd, a month. And, during that month, it was painful for a lot of people. I get it. But those are where the best buying opportunities are. And those best buying opportunities come from having a goodly amount of resources around you. And that's what we do at Finom Group. We resource you. We give you the tools to understand where and why a bottom could be forming and how to engage that bottom within your risk tolerance and what have you. But speaking to, did we know there was a vaccine announcement? Now, nobody knows, of course. You don't know for sure. But we've been following the Morgan Stanley research from Matt Harrison for the last 4 or 5 months. And the guy's been spot on. And his timelines for when the vaccine readouts were supposed to come, he's been forecasting it for the month of November. Now, his forecast for Pfizer was the 3rd week of November, basically right around Thanksgiving. It came a little early, but man alive, talk about getting it pretty darn close. His forecast for the Moderna phase 3 trial readout was for basically the 1st week of December. Again, just a couple weeks shy on that forecast. So we had an inclination at Finom Group. We disseminated all that information to our members so they could have an understanding of why this market continues to get bought on every single dip. We had a 10% correction, we had a 9% correction, and we quickly snapped back. Why? Vaccine's on its way. We're getting that much closer to the other side of this pandemic. This chart right here, this is our 2020 versus 2009 analog. Comes to us from Charles Schwab. They've been updating this every week. And as you can see, the dark blue is 2020. And the yellow, forgive me, I'm colorblind. So if I say yellow and it's not yellow, help me out. The light shaded line is 2009. You can see, it's impeccable. We get some deviations here and there, but we're on the same path. We may be on a different plane of time, but we're on the same path. It's uncanny. Now, coming into this week, what we needed to accomplish in the S&P 500 in order to stay on that path and on that same plane was a rise of 2.2 or 2.5% here this week, this trading week. So as we wrote, will the next move be higher? The map implies about a 2% over the next 2 to 3 trading sessions. But we know there are no guarantees and the path may prove the same, but along different plane. Maybe we do get another positive vaccine headline this coming week, as Moderna is widely expected to announce phase 3 trial results publicly. So again, our reports go out every Sunday. It's a way to make sure our members who are active traders, some of them are sell-side analysts, some of them do work for big institutions, and it's a way for them to have a game plan, establish a game plan for their trading week, and to have reasonable expectations. We want to give everybody reasonable expectations so far as the trading week ahead is concerned. This way, you're not necessarily reacting to price action, but you're reacting to a game plan where the price action just happens to fit the game plan that you've already established. When you put all the pieces together, you essentially have a very disciplined approach to trading and investing in the markets. All right, today, the biggest economic news of the day was the retail sales report. In my opinion, the biggest one of the week. In this kind of COVID pandemic period, I also think that the biggest economic data every week happens to be jobless claims, because it's a fast-moving, high-frequency data, and you're getting a real-time picture of what's going on in the labor and employment market. But for today, it was those retail sales, and I want to try to whip through this, give you my thoughts on it. Missed expectations. Sorry. This is the Census Bureau's PDF, right from the Census Bureau. You can see it came in at 0.3%. Expectations were for 0.5%. This is month over month. When you see the headline, it's just month over month, folks. It's not year over year. Why they do that, I don't know. It pisses me off to no end, because the year over year is generally really, really strong. And then it confuses people. They see a less than spectacular retail sales report, and the market still goes up, or the retail sector stocks still go up. And they're like, why is that happening if it missed estimates? It generally is because the year over year is so strong. Year over year was up 5.7%, folks. 5.7%. All-time high, record retail sales once again. You look at the retail sector stocks here today, and the retail sector itself, the sector ETF, up 23 cents. The XRT. Look at Kohl's, Williams-Sonoma, TJ Maxx, Macy's, all higher here today. Best Buy, higher. A miss on the month over month is not that consequential, especially when you're growing year over year retail sales, 5.7%. Something that doesn't get headlined, but the revision was also negative. The September sales revision dropped from 1.9% growth to 1.6% growth. What I tend to do when I look at retail, when we get them every month, I go to the categories. It helps me with trading. It gives me an idea of where the retail landscape is heading and where it has come from. I like to go to department stores in this day and age of e-commerce, and because I see some of these zombie department store companies like Kohl's, like Macy's, or specialty retailers like Bed Bath & Beyond. These companies are in dire straits. Forget about what their stock prices say. These companies are in dire straits. So we look at department store sales here. I'll blow it up a little bit. And you can see month over month. The first column is month over month. Second column, year over year. First column, month over month, down 4.6%. Now, the comp was hard. All right. So the comp was hard. I mean, it was up like 9% month over month in the September report. So I get it, but still negative 4.6%. That's a bad number. More importantly, this is a horrendous number. You can't, when month over month, I get it. It's a hard comp from the previous month, but you can't deny what's going on here on a year over year basis. And again, this is your Dillard's, this is your Macy's, this is your Kohl's, this is your Nordstrom's. Specialty retailers qualify as well. Your Bed Bath & Beyonds. Want to know why Pier 1 went out of business? You want to know why Kmart and Sears are out of business? You know, all of the, I mean, it's chipping away. E-commerce, every single week of every single month of every single year, e-commerce is just chipping away at these department stores, clothing, apparel, accessory type outlets every single day of every single week of every single month of every single year. E-commerce is just chipping away, up 3.1% month over month. Non-store retailers is e-commerce, up 3.1% on a month over month basis. This right here is just gaudy, folks, up 29.1%. It's just like there's a hose. There's a siphon from here down into here. Now, here's the thing that concerns me, especially with the infection rate rising, hospitalization rates rising. What concerns me is what's going on in food service and drinking places. You can see that's down on a month over month slightly, but pretty substantially on a year over year basis. This is your restaurants, bars, eateries, and what have you. Why does it concern me? It concerns me because here's the September report, folks. Food services were up 2.1% from August to September. This is a September report. Now, it was still down year over year, but the trend was better. On a month over month basis, the trend was better. And again, you can look at department stores, as I said before, this was up 9.7%. I give you it was a tough comp for October, but year over year was down 7.3% here, and it's down 11% now on a year over year basis in department store sales as of the October report. Nonetheless, and back to my main point, this is what's concerning me so far as we got a market at all-time highs, basically, give or take a few points. And we have a situation where we know that we have regional reimposition of economic restrictions, stay at home, advisories and orders, just depends on which state, which city, what county you're in. And we see that these are progressing, as they should. And that's just my opinion. We pay taxes for our government to protect ourselves, to protect us in one way, shape, or form. If this is that one way, shape, or form, so be it. We're fighting this pandemic until we've eradicated it to as much a degree as we can. So now we're seeing this data, from the food service, which we know is the industry that is going to get hit the hardest and has been getting hit the hardest. We're now seeing it show up to some degree because we're, over the last couple weeks, we've started getting these restrictions, no more dine-in eating in this area, this state or this city. So it's affecting these industries. And we're still at all-time highs in the S&P 500. So it's just kind of putting things into perspective because most of the restrictions and a majority of the infection rate and worries have accelerated here in November, but this is the October report. So what is it going to look like when we get the November retail sales report? We're not going to get that until December, mid-December at that. Point being, usually the market is a forward pricing mechanism. It's going to price this, that data in ahead of time. So as of right now, from my purview, this is relevant to me, that we have gone negative and the trend is not your friend with respect to, restaurants and services. Manufacturing's been good, but this is a category that suggests to me, you got a game plan to buy stocks on a dip, you may just get that opportunity near term. Some other headlines today, of course, here's Kohl's. And again, down 13.3% same-store sales comps. Expectations of 11.7%. Digital sales growing 25%. Who's not growing digital sales? That's not This is not your go-to. If you're a Kohl's shareholder, that's not your go-to. Gross margin slipped a little bit. I'm surprised they didn't slip more. So good on them. Merchandise inventory decreased. That's probably why. They're lowering their inventory levels, discounting to a lesser degree. You have to do if you get out in front and you lower your inventory. It's a substantial decrease in inventory, folks. Substantial, 26%. Something's wrong. You're decreasing your inventory 26%. Something's wrong with your business model. This is a red flag. I don't care so much that this was a minor blip in gross margins. This is a red flag. And I don't even care that they missed on same store sales. That's expected in as far as I'm concerned. Other than that, it was a beat on the top line, beat on the bottom line. Shares of Kohl's have been beaten to heck since COVID. And so, you get these beats and you get an outsized performance in the stock. I wouldn't make too much of it. In my opinion, Kohl's is a long-term short opportunity. Nothing has changed in Kohl's business model. Nothing's going to change. It's a department store. What are you going to do? The way I look at it, until they make the decision, just like Macy's, until these companies make the decision that they're going to take half of the store, push all those clothing racks out, all those shoe dividers out, and put in grocery racks and freezers, it's the same business model. You're not going, this is not a ship that's all of a sudden going to turn around. You'll constantly hear on CEO calls, on conference calls, we're doing this, we're doing that, we're doing the other. None of those things ever, it's been 10 plus years now, have gotten people into the store, A, to see that you're doing this, that, and the other in the store, and B, it's in the store. That is not where people are going as much. Worst part of it, when you look at what Walmart did. Walmart had fantastic results also. They're growing e-commerce, which is actually a decline. They were up, I think, 100+% in the last quarter, Q2. They grew e-commerce sales 79%. Hypermarkets are working, folks. They're essential. And in this time of COVID, people want to kind of narrow where they're going. They don't want as many touch points with the world as they had before. So you can get most of your stuff at Target or Walmart, or even Costco for that matter. Another point I want to make here with respect to that, and this is a good tweet by Robert Hume, CNBC contributor. Walmart said that its Walmart US digital sales made up 89% of the same store sales growth in Q3. Back in Q2, during COVID, in Q2, when peak COVID, when we got locked down, digital sales made up just 65% of comp growth. What's the extrapolation there? The extrapolation there is the folks that were first timers here, right? Maybe, your baby boomers maybe that have never had to shop online, had to during the Q2 period. Guess what? They learned it's not that hard. It's pretty darn convenient. And I can check prices anywhere to get the best deal. That baby boomer that maybe made 2 to 3 trips to Kohl's or Dillard's or Macy's every year, maybe now they only make 2 trips or 1 trip. And therein lay the problem, folks. Therein lay the problem. Walmart is taking significant market share. Amazon's taking significant market share during this COVID epidemic period. I've never heard of Walmart just handing over that market share. Have you ever seen Amazon hand over that market share? No, you can have it back. That's not what these companies do. So good on Kohl's, but this is going to be short-lived. Short-lived, that's subjective. Maybe it's a year. Maybe it's 3 months. But I am not a buyer of this business model. These department stores, they got into this situation because they couldn't shift. They couldn't shift. It really comes down to if you're not a hypermarket in today's era, it's just not going to work. Macy's was under $10 a share before COVID. Like, you're talking about a company that in 2015 was a $50 stock, all the way down to less than $10 a share. These are bad business models, folks. I'm a buyer of Walmart. I like Walmart long term. I'd be a buyer on the dip on Walmart. Redbook sales, this is another way to look at retail sales. This high frequency data comes out every week. You can see positive. 9 weeks in a row. Just came out today with the Census Bureau. It's a little weird. I do expect to see some weakness from this in the near term, but we shall see. So with that, so look at retail sales. I am a little concerned about what we're seeing so far as the restaurant industry and how that's going to, play out here in the back half of the fourth quarter. Will fiscal relief come? Will a second package get voted on? I think that's a question. Well, it's not really a question for the market. The market dictates. Market just hasn't yelled for it yet. They're just saying that, politicians make policy, which is not the reality. The market dictates policy. When the market speaks, then things start to move. The market spoke in March. Policy came shortly thereafter. Market's going to all-time highs, each and every month, it seems like. It's not ringing alarm bells with our elected leaders. But when it does, you'll have it. So with that, it's our inaugural video from Finom Group. If you liked it, hit that like button for our YouTube channel and subscribe to Finom Group. We have a basic membership. We have a contributor membership. And let me get there real quick, sorry. We have premium and mastermind options. There we go. We hold a live trading room every day for our premium and mastermind option members. And again, we are heavy traders. You can see this is our spreadsheet going back to 2019. We did not trade in March. As a disciplined investor, I was not issuing trade alerts during the month of March. You can see dropped off from end of January. Stop trading. We did not, we didn't have a full understanding of how the situation was going to play out. The best approach to engaging the market was to monitor, extrapolate the educational value that the market was delivering at that time. There was no certainty as to what was going to happen next with COVID, with how governments were handling it, with how long we would be locked down, with fiscal, with monetary from the FOMC, from central banks all around the world. Without that degree of certainty, it's a rather untradeable environment. You can buy dips and you can look for indicators that suggest there's a bottom in sight. And we did find those indicators and we did disseminate them on March 22nd, the day before the market bottom. But we picked things up right away in the month of April. And since then, we generally generate anywhere from 5 to, I think our busiest week was 13 trade alerts for the week. And they're generally scalps and swing trades. Singles, as we call them, we look for 1% profits. Every now and then we get bigger profits that we can take. But folks, you hit enough singles and a few doubles here and there, by the end of the year, you got a few home runs. Those are in the, we'll call it yellow. And you build core positions for longer term investments through these scalps and swing trades. And as you can see, we get some home runs here at the end of the year. This is part of our game plan at Finom Group. We wanted to be shorting volatility going into the election. Oh, that's crazy. Volatility went up to 40. Well, that's what we wanted. We wanted volatility to go higher so that we can get more exposure on the short side, because after the election, historically, the next 10 days sees the VIX go lower. And again, that's information research that we disseminate to our members in our weekly research report. These are home runs, folks. 10% profit, 8% profit, 9% profit, 6% profit. This was part of our game plan for the election. There's a good 200 plus trade alerts here, just since April. So we stay engaged, we're active. If you like what we have to share, and I'll be trying to do more and more YouTube videos, when topics are relevant, and I think that there's good information to share. But in between now and then, please hit the like button and join us at Finom Group. Thank you.